we're less concerned about our brand visibility and awareness and people using our software versus working with our consortium partners and enterprise partners almost from a white label basis. When I said, we want to kind of be the Salesforce of enterprise blockchain, it's exactly that.
The startup investment landscape is changing, and world-class companies are being built outside of Silicon Valley. We find them, talk with them, and discuss the upside of investing in them. Welcome to Upside. Woo!
Hello, and welcome to the Upside Podcast, the first podcast finding upside outside of Silicon Valley. I'm Eric Hornung, and I'm accompanied by my co-host, Mr. Fireworks enthusiast himself, Jay Klaus. Jay, how's it going, man?
It's going well. It's been a week of fireworks, my friend.
And you love fireworks, especially firework pictures.
Oh my gosh, this is a train I've been railing on. Is that the phrase?
No, it's not the phrase.
This is something I'm very passionate about, the idea that all fireworks photos look the same. And so stop taking photos of fireworks. Just look at the fireworks. They are very fleeting, ephemeral things. Just enjoy them with your mind and your brain and your eyes.
They're going to be outlawed for drones soon since they're harmful to the environment. So we follow China's path.
And I would love to bring a guest on the pod who is in the fireworks innovation space. There is not enough innovation in the fireworks space, and I feel like I've been seeing the same fireworks show my entire life.
Well, if anyone out there is in the fireworks innovation space, if you're doing something crazy with fireworks, yep, we're looking for you here on Upside.
Actually, I had a very interesting conversation as we're watching fireworks of how could we innovate in this space? What could we do? And drones was the biggest crux of our idea. Drones and magnetism. I don't know if that would actually work, but I think it could. I just want to see more tangible shapes and ideas in the fireworks,
Yeah, but then you get this idea of it being too manufactured, and this point is becoming too belabored. So let's move forward to why we're here. Jake, you talk to the audience about what we're doing here?
Here on Upside, we're talking to founders outside of Silicon Valley. Eric and I believe that it's an amazing time to start a company outside of Silicon Valley. We think time has never been better. And so every week we're here talking to founders who are doing just that. Founders who are capital efficient, opportunity seeking, very intelligent, and oftentimes more resilient than their Silicon Valley counterparts, we would argue. So that's what we're doing here on Upside. Eric, did I miss anything?
Just that we have a unique structure here on the Upside podcast. It's a 3-part structure in which the first part is a discussion between Jay and I, touching on some research, some key points, some potential areas of concern, heading into part 2, which is an interview with the founder about themselves, their company, and the opportunity. And finally, a deal memo, a verbal deal memo at the end, which we'll walk through a little bit more in depth in part 3.
Actually, that third part of our show is my probably favorite part because that's where Eric and I spend a lot of time synthesizing our thoughts around the company and talking about where we think the opportunity lies, things that we are excited about, things that maybe give us some pause. And that is where we would like to hear the most input and feedback from you guys. So if you guys have ideas on our show, whether it's any section, we would love for you to tweet at us at UpsideFM or email us hello@upside.fm.
And that kind of engagement is invaluable. We are on Breaker as well, where we get comments about some of the things that we're seeing, some of the things that we're saying on the podcast. And we engage with everyone who reaches out to us, whether it's on Twitter or on Breaker or leaves a review on iTunes, if we have a way to contact you.
Shout out to Breaker, the social podcasting app that Eric and I are both very bullish on. So yeah, we'd love to hear from you. Tweet at us, talk to us on Breaker. If you enjoy our show, please leave us a rating or review on iTunes. It means a lot. Eric, today we are talking to Michael Hiles, the founder and CEO of 10XDEX, which is based in Cincinnati, Ohio. 10XDEX builds transparent, decentralized, secure solutions for industry and governments using public and private blockchains, smart contracts, Ethereum, advanced data architecture, cryptography, artificial intelligence, and predictive analytics. I laugh a little bit because these are big idea words and a lot of them. Today is going to be a technical episode.
And that's why today we're bringing in a special guest, Anthony Pompliano, a.k.a. Pomp. Jay, do you have a background on Pomp?
Super excited for Pomp to be here. He's the founder and partner of Morgan Creek Digital Assets, a multi-strategy investment firm focused on providing access to blockchain technology and digital assets for institutional clients and wealthy family offices. Pomp formerly founded Full Tilt Capital, which was acquired by Morgan Creek Capital Management. Before that, he was a product manager at Facebook. He led growth at Snapchat, and he's been a sergeant in the U.S. Army. So a very accomplished guy. And if you follow the crypto and blockchain space at all, I'm sure you've come across his name. He's definitely out in front and leading the pack.
I'm really excited to talk to him. You want to jump in?
Yep, let's do it.
Pomp, welcome to the podcast.
Thank you guys very much for having me.
So let's start with your investment thesis at what was Full Tilt and is now Morgan Creek. Can you kind of walk us through that?
Yeah, look, I think that Morgan Creek's a multi-billion-dollar asset manager. They've been around for 15 years, started by Mark Yusko, who previously ran the UNC endowment and the Notre Dame endowment. And so I think from Full Tilt's perspective, we wanted to invest in the crypto space for our second fund. And I think we saw an opportunity to deploy large amounts of capital into the market in a very kind of professional and sophisticated way. But we also realized that we needed more firepower, right? So it was just myself and my partner. And I think that we really thought that we were going to have to raise capital from institutions. So we had two options. One was either to go and, try to build that ourselves or to go and merge with one. And so merged with Morgan Creek. And the nice thing about Morgan Creek is they've got the track record as an institution over a long period of time, managing billions of dollars. They've got all the licensing, SEC registration, BD license, et cetera. They've got a built-out sales team, an investment team, et cetera. And so we're kind of able to come in and hit the ground running day one. And as my partner likes to keep saying, it's like going straight from high school to the pros, right? It's pretty exciting stuff.
Well, hopefully you guys are like LeBron there then. When you say that you guys are investing Fund 2 in crypto, is that the tokenized securities side of crypto? Is that the Bitcoins of the world? Where are you kind of putting investor money?
I'll have to talk kind of broadly here without discussing the individual funds. But I think that, from a philosophical standpoint, we believe that any investment strategy that exists in the non-crypto world can be applied to the crypto world. And so if you look at it, whether it's equity, debt, real estate, et cetera, there is a correlated or a similar strategy that can be applied in the crypto space. And so that's really our focus, is how do we take these kind of traditional strategies and apply them? And what that means is, at times will we take price volatility risk or custody risk of holding individual tokens? Yeah, sure, right? But other times we won't, right? Because if you're buying equity, right, or you're buying real estate, for example, then you might not have to do that. And so I think that my big piece of advice, I think, to a lot of other fund managers is just because it's crypto doesn't mean you have to lose your mind, right? There's still kind of a lot of the core investing principles are there for a reason. And so following them are usually a pretty good approach to life.
I listened to a podcast with you recently on the Venture Coinist, and you talked to that point, which was the point of if you're investing into the blockchain or crypto space, that doesn't necessarily mean you need to change the way that venture capitalists approach evaluating that as a business opportunity and as a returnable opportunity. Can you talk about that a little bit more and the dichotomy you see between how some people approach investing in the blockchain or crypto space versus what you're saying as not losing your mind?
Yeah, look, so let's just talk broadly about investing in general, right? Who are the people? What's the opportunity, right? What's kind of the upside and what's the downside? What's the risk? And then that's obviously overly generalized. But I think that there's a lot of people who are forgetting that stuff. So think of the people who are investing in a lot of these liquid token projects that aren't receiving equity, right? They have no clue who runs the project. They've never talked to those people. And so you're betting on an early stage project. And so you probably would never invest in a startup without knowing who the founders were and talking to them. And so people are just kind of losing those core principles. And so I think the same thing goes for risk and measuring it, right? So I think I've said a couple of times now that crypto investors like to ask how high can it go? Institutional investors ask how low can it go, right? And so I think that that's just at odds with each other from a mindset perspective. Doesn't mean that either one's right or wrong. They're just different. And so I think that there's just these core principles that come with investing that it doesn't matter what asset class you're investing in, you still should at least be aware of them. Doesn't mean you have to adhere to every single one of them, but just completely throwing out all traditional investing principles and saying this is different and in every way probably isn't going to, history's not going to be kind to those people.
So the way I kind of see the space is there's kind of three buckets of crypto assets right now. And this is probably a little oversimplified, but I think it helps kind of frame people. Those are the payment coins, that's the Bitcoins of the world, the platform or utility coins, so that's the Ethereums and the EOSs of the world, and then tokenized securities, which is, I think, this developing space in the crypto space, like a subspace, I guess. Is that kind of how you see it, or is there a different structure for how this kind of space is developing?
Yeah, I think that from a high level, that's probably a good framework, right? I think FISMA or whatever came out with that, a while ago, and I tend to think that they're generally correct. Now, will there be things that are kind of hybrids or the edge cases? Of course, but my guess is that you probably capture a high majority of the market by kind of putting them into those three categories.
What are some of the benefits of, let's say, a real estate company that owns one apartment building? What's the benefits of tokenizing that kind of asset?
Look, there's a number of advantages that come from tokenizing an asset. I think that it's almost beating a dead horse at this point when it comes to, access to an investment asset, liquidity, global marketplace, 24/7, all of these things that have just been talked about enough. Mm-hmm. Really, our thesis, though, we like to say that tokenizing assets compared to traditional public markets is not revolutionary. It is a mere evolution of the technology. And for main use cases, it's not that great of an improvement. It is a bigger improvement for the edge cases, right? So like the stock market's closed more hours a week than it's open. Okay, we have a 24/7 marketplace. Like that is an improvement. Is that a material improvement? Maybe, maybe not. I frankly don't care, right? In terms of, is it or is it not? I think that my thesis around the tokenized securities is less to do with the underlying technology and has everything to do with user activity and psychology, right? And so the thing that, if you ask me what do we believe that a lot of other people in this space don't believe, almost everyone else starts out with the tech. I actually come at it from the other side and I say, well, what are users going to do, right? How do they think? And so that is a nuanced way of looking at it. Some would say it's important. Some would say it's not. In this case, what that leads you to is if you believe that the digital wallet is the new brokerage account, all of a sudden, it doesn't matter if the underlying tech is actually an improvement or not. It means that in order for, let's say, everyone under the age of 35, they're now going to buy and sell their assets through digital wallets. And so if you want your asset to be held by that user base, you have to be tokenized. It's the only way that they can actually hold the asset in that brokerage account or in that digital wallet. And so I think people get caught up on the nuances of, is 24/7 marketplace better? Is global liquidity actually going to be a thing? Whatever. And I think they've just got to look at it. Look, Coinbase today has 20 plus million users that are buying and selling currencies and commodities, right, that in a digital form. And so would those people like to also own their real estate investments on that same platform? Would they like to own equity in, companies there? Probably, right? And I think the first sign that we're seeing that is with Robinhood, right? They came out and they said, look, you can now trade Bitcoin alongside your equities, right? And also they get a mass influx of people. And so some of that's driven by the hype of Bitcoin, right, and the price appreciation and all that. But I think there's a lot of validity to this idea of people are used to, these digitally native generation are used to certain interfaces, user experiences, etc. And it's just not attractive to them to go use the legacy tools. And so therefore, assets for probably one of the first times ever are going to have to keep up with the user interfaces and modernize themselves if they want to be on those platforms.
So if you, as an investment firm, or if you were giving advice to someone who is looking to invest into tokenized securities, where are some of the red flags you would be looking at in evaluating companies? Or what is something that would be a really good, call it green flag, in looking at a company?
Yeah, so, and this goes back to like, don't lose your mind type comment, right? If it's not a good asset in the private market, it's probably not going to be a good asset in the tokenized security market, right? And vice versa. If it's a good asset in the private market, it'll be a good asset here. I really, really do think that this is more similar to the traditional world than it's not. I always tell investors, the egregious example is if you're not a day trader, don't day trade, right? If you're not a real estate investor, then you probably shouldn't invest in real estate. And so same thing here is if you wouldn't invest in this in the private market, why are you going to invest in it in the tokenized market, right? It makes no sense. So I think that's one. The other thing too is, look, there is going to be a period in time where there is a great amount of misinformation or lack of transparency in the market, right, which will create inefficiencies in the market. And so I think people just need to be very disciplined with, should you overpay 10% to the private market valuation or 50%? I don't know. It's asset dependent, right? But at some point, people have to realize that there may be some changes or premiums or discounts on assets, but 50, 100, 300% is unlikely to be sustainable in the entire market. That doesn't mean a single asset, right, might not deserve that. But I do think that, the people who are saying, hey, there's going to be a 200% price appreciation in, all real estate, I'm probably not as supportive of that stance as I would be that, good assets will go up, bad assets will go down. And by bringing it to a free market, you get a repricing of all assets and just better price discovery. Right, that seems more reasonable to me and likely than kind of everything's going up into the right forever.
How does someone go about actually tokenizing an asset? What does that look like? Do I have to go to a securitized and use their platform, or how do I do that?
I think there's a couple of pieces here. One is there's just the legal structure and regulation component. So it depends on if you've got an existing asset or you're trying to start a company, for example. In most cases, for an existing asset, there's already some sort of cap table or share certificate, like structure. And so if there's a cap table, you can simply take that cap table out of eShares or Excel, et cetera, and put it on a blockchain, right? It could be as simple as that. You could, if there's paper share certificates, you could basically cancel out the share certificates and issue digital tokens as actual shares. You could recall the paper shares, right, and then issue digital tokens. So I think it really depends on what's the current structure and how do you basically digitize the business, right? Mm-hmm. And then if you're starting something, my general recommendation in the space is don't ever go to paper. Just start out completely, 100% digitized, and you don't have to worry about kind of legacy structure, et cetera. And so once you kind of figure out, okay, here's the structure we're going to use from a legal and regulatory standpoint, you can build the tokens yourself, right? You got to pick a protocol you want to build on, or you can go use one of the existing service providers, right? So, Securitize, I think, has kind of executed the most, right, in the space. Obviously, Harbor is up there with them in terms of name recognition and kind of the capabilities of the team and funding. And then you've got CoinLists of the world, right, who are really driving large fundraisers. Templum is another one, right? And you can kind of go down the whole thing there. There's probably too many to name. And then I think that you've got to really determine, once you figure out what protocol and what issuer you're going to use, then it comes down to the exchanges, right? And I think that's the biggest question mark right now. Open Finance is up and running, but I think that Templum's done a couple of these smaller transactions kind of in a private market, if you will. And then T0 obviously has done one. But I wouldn't be surprised if New York Stock Exchange and NASDAQ jump in. We just saw the Swiss exchange jump in from Six Group, Coinbase, Circle. I think they're all coming, right? And it's less to do with we're building security tokens. Or I keep telling people, I don't know what a security token is. I do know what a tokenized security is, right? And so I think that all they're doing, again, is they are just creating interfaces for the users to operate or to transact with. And people are going to be forced to digitize their assets or their asset ownership in order to have exposure to that user base, right? And so it's frankly kind of boring when you compare it to all the kind of cool stuff that people are doing in the hardcore crypto world, right? Whether it's the security stuff and privacy stuff around ZK snarks or things that people are doing with governance and Bitcoin and smart contracts. All that stuff is so fascinating to me. This compared to that is fairly boring.
So some of those companies you named off, the Securitize, the Harbor, if you're looking at a technology that helps other people tokenize their assets, what is interesting about that opportunity or not interesting about that opportunity to you as an investor? Are you more interested in the assets themselves, or do you have interest in the platforms that help people tokenize?
Yeah, so I don't know what, from a legal compliance standpoint, I'm allowed to say and what I'm not allowed to say. So I would just say that we are investors in some of those companies and in some we're not. We are familiar with all of them. but with both the teams themselves and then also the projects. I think that it is very much infrastructure and kind of picks and shovel strategy, right? So if you're an exchange, you really don't care whether a single token goes up or down in value, right? As long as people are transacting. If you're an issuance platform, you want to work on the highest quality projects, right? But to some degree, you just want a high volume of projects, right? And so I think that a lot of these infrastructure players in this space, they're selling the shovels during the gold rush, and the people who buy the shovels, whether they find gold or not, is less of a worry. I will give credit to a lot of these teams, though, that they're being very thoughtful about the projects they work with, right? So they're not just kind of blindly saying, hey, we'll take everything. They're saying no to people, which is, I think, a good sign. But at the same time, I think that their business model is very much based on the overall industry growing, right? The volume growing, which is a good place to be, for this market, I think.
Awesome. Well, thank you very much, Pomp, for coming on the podcast. We really appreciate having you. You giving us a lot of insight and our listeners a lot of insight to frame this interview we're going to have in a minute.
All right, guys. Thank you guys so much.
Michael, welcome to the show.
Hey, thanks, guys, for the opportunity to talk to you this morning.
Yeah, we appreciate you coming on to the show. We would like to start kind of with the background of Michael. Where were you at growing up? Where are you from? What's like the history of Michael?
Well, much like the Willy Wonka movie, I won the golden ticket. I was a little kid, and my dad worked for one of the first independent software vendors in existence, Syncom Systems, based in Cincinnati, Ohio. Syncom was the very first company to ever figure out that companies would be interested in buying software from someone other than their hardware vendors. And I started coding, hung around the office, and this little kid was interested in computers. And I just had no idea that it was not normal. Most people hadn't even seen a computer in that era. So I started coding on a PDP-11, which was a Digital Equipment Corporation system, DEC, back in 1979. And they let me mount some tapes and run some batches. And I was really interested in logic and actually writing code because I knew that's the magic. So they gave me a Dieball compiler, which was DEC's version of COBOL. And, I started hacking out on VT220 Amber monochrome monitors and, quickly moved into PCs because that was the era, and started to, acquire my massive Smithsonian-esque collection of former platforms, everything from, Zenith Heathkit to Tandy TRS Model 1 with the 8-inch floppy, and just kept right on cruising from there. Did my first consulting gig, actually got hired by my local radio station. I was friends with the DJs. This was back in the days of the old cart systems when they would plug in the commercial carts, and they managed everything with a 3x5 card box. Well, the DJs would get to jacking around in the studio and knock over the cart box and spill all the carts, and commercials would get missed and not played. So, the sales guy and the station manager had come marching into the studio like, you guys didn't play so-and-so carpet cleanings commercial at, 9:58, So I just off the top of my head, well, you guys need to write a little, database to manage this. And that was my first consulting engagement. I actually was 15 years old and got paid $6,000 to write a Pascal-based cart management system for the radio station. So I was pretty hooked, so I came at it from the engineering side, but my dad was in sales. So, while I'm looking at the engineering stack and staring at code, listening to he and all of his colleagues actually on the phone selling it, and, understood how to translate, the tech into features and benefits, and really be that translator. So when I say I got the golden ticket, that's literally the other part of it, is not just tech, but then also the sales and marketing and being able to speak conversantly in business language for non-technical people. I started a web development company in '94. One of the first in the Cincinnati area to get into the web. I saw the web really being, the next major phase of technology and computing. I'd already been through, the transition from mainframe to client server, and, moving from token ring to Ethernet, and, all the networking protocols. And so when the web started to really rear its head, I knew that that was the next big opportunity. And so I started a little company called SoftLinks Interactive and grew the company up, had, almost 20 people at our peak. Unfortunately, the timing wise, I was hitting my peak about the time that I saw the storm clouds brewing for .com 1.0 and realized that most of my client base was either venture funded or venture backed divisions of bigger companies. Realizing that these guys are all, burning against cash, not making the cut. What am I going to do in 9 months when the well runs dry? And so I started talking to a client of mine whose older brother owned Reach Magazine. So you guys get the coupon magazine in the mailbox. And the suggestion was made, hey, this might be an awesome partnership. So I merged SoftLinks Interactive with Reach Publishing. Spent a couple of years there.
Mid-90s, late 90s?
This was 99. This was 99, 2000, 2001. And by 2000, 2001, the .com bust had really, kicked in gear. But, we were riding high early on. We were selling remnant space and the coupon stuff to Earthlink and Yahoo and all the major players back then. So connecting, national ad buys, because that's one of the things Reach did. Reach owned a very significant portion of the largest Valpak markets as a franchise, which is Cox Media, Cox Digital Group. Being able to go in and syndicate large block ad buys in multiple cities with Earthlink and Yahoo and all those guys. That's really how we were making money at the time.
Speaking of making money, you made $6,000 when you were 15. I know when I was 15, I would not have spent that the greatest way. What did you do with that? Like $6,000 at 15 is a lot of money.
Well, you remember when MTV rapper videos had the big giant block cell phones, the brick phones with the whip antenna, and I'm also a musician. I play keyboard. I was in piano lessons early as a kid, and so I would buy like MIDI and recording gear, and blow all my money on gadgets. And I look back on the millions of dollars that I spent on nothing in my lifetime, and now I'm old and have kids, and it's like, oh wow, that was stupid. But
You still mixing in the basement or what?
No, I haven't. I've been away from that for a while, but I still love it. I follow the scene. I'm totally into the digital electronic music and all the recording equipment. But at one time I had like a fully decked out, full blown studio. I produced albums for bands, and it was kind of a side hustle gig.
That's cool.
So
you started in Cincinnati. You were born in Cincinnati.
I was born in Cincinnati, but then I spent a fair amount of my elementary school years in St. Louis. Then we moved back in the early 80s to Eaton, Ohio, which is about 40 miles north of Cincinnati, about 30 miles from Dayton, right on the Indiana border. So I'm a country boy, which is really also interesting. Get my little country twang going on. So, being out in the sticks and being a digital nerd that's, running current with the rest of the big city populations is kind of an anomaly, I guess.
So it sounds like you've been kind of at the cutting edge of technology for a long time.
Yes.
At what point did you start turning your attention to the blockchain or crypto space?
Well, I was following it very early, because it's not new. If you look at blockchain and look at the technologies that underpin blockchain, token ring has been around for a long time, right? Every computer attached to a token ring network functioned as a node. So you had peer-to-peer models were around many, decades ago. And then, of course, we came through the evolution of file sharing with Napster and Nutella and, all of the, LimeWire, in that era when people were sharing MP3s across decentralized, peer-to-peer networks. So the collision of all of those technologies and the time frame that it happened was inevitable, really. So, being able to distribute a hash key pair across a decentralized peer-to-peer network is not necessarily cutting edge. Everybody thinks that it is, but when you look at it in terms of prior art and the evolution of the tech, it's certainly, the natural progression. So when it came along, and I was already clued in and, just interested from a, academic, just enthusiast standpoint, didn't really get into mining Bitcoin until like 2011. When you could still mine it on PCs, basically, I ran some mining software and generated a couple of Bitcoins that were, sold long before the value was really there. So, I joke around and I say everybody suffers from crypto regret in the space.
Crypto
It'll be
FOMO.
it's going to be like a entry in the DSM at some point as a form of depression. I used to have like all these Bitcoins or Ethereum, and I sold them at $30, and whoops, kind of a thing. So anyway, that's how I transitioned into the space. I didn't really lean in on the technology because by that time I had a lot of experience in market cycles of tech, and it's still such a nascent, emerging space, even after 10 years. So from a practicality standpoint, it's not like anybody was rushing to buy blockchain in 2011, and I don't think people are still rushing to buy blockchain in 2018. It's emerging, certainly, but when I'm interviewed by, CB Insights and Gartner, and they're asking me, from a future standpoint, how does this look? And I'm like, well, you look at Gartner's numbers that only really 1% of CIOs across, I don't know, they have probably 70,000 that they tap. Only 1% actually have anything going on, and only 9% have active plans to do anything in the blockchain space. And this is, 10 years after the fact. So there was plenty of time to really foment my plans and put them into place. So I leaned in and started planning based on some financial hypotheses that I had in late 2015, early 2016, in particular around how does blockchain impact equity, early stage equity transactions. The hypotheses that I started working with, because I was also exposed to equity, and I'm a serial entrepreneur myself, been through capital raises and mentor in the startup space, and really understanding a lot of those intrinsics, saw the opportunity for blockchain when it came to actual real world existing assets, as opposed to, just crypto assets that had really no backing other than the economics of belief. But the technology is extremely useful, and you can solve a lot of problems with it. And I saw the illiquidity in the alternative asset space and the collision of regulatory compliance and all of those issues that were swirling around. When's the right time to start the discussion? And so 2016 started identifying team members, putting the hypothesis together, formalized the company in 2017, raised a small round to get our MVP underway and get a couple of our engineers on full time to start building out the foundation of the future of what we're progressing and working towards. It's funny because I have the same conversations with crypto folks right now that I had in the early 90s around information. It's like, oh, this platform is going to undo the big banks, and we're going to undermine the man, and we're going to change the world. And I'm like, well, I literally had this exact same conversation 20 years ago. It was just around the internet and information. You had the crypto. They were cypherpunks back then, right? It was all guys in their basements that were hacking away at web servers and web, and they thought that, hey, this technology is going to democratize things and make a different world. And I'm like, yeah, well, you have big companies with trillions of dollars in cash to invest in these things. They're just on the sidelines waiting to spend the money in an optimal way at the right time. And I don't care how much money you raised in your ICO, you do not have the cash burn and the run rate. I mean, it's very costly to acquire customers. And when you have companies that already have line of business applications and already have customers, my positioning in the market was less of trying to go out and create the front end brand and a hype around my DApp and my, verticalized application. And we're going to do this and we're going to do this. And I got a lot of friends that are, still pursuing that model, but I saw the opportunity to really follow the enterprise path and say, you know what, there's going to be a giant segment of the enterprise market that understands blockchain. They're going to wrestle with the benefit versus the cost. They're going to arrive at a use case model. And then, they're going to discover that the technology is only about 10% of the effort when it comes to ledgers. 90% of the effort is around building consortiums and, building out the ecosystem with the proper governance, the proper risk mitigation plans, those kinds of things to make the technology really feasible for the enterprise space.
Let's take a step back and just kind of define what 10xTS is doing in the space. What are you providing customers?
Well, that's an interesting question because to date, we've been fairly nebulous about the direct conversation because we've been in stealth mode for the product. So people know who we are. They know, that we're in the space. They know that we've got a, kick-ass, high-powered team. This is complicated stuff. And given that, we were identifying a traditional enterprise sort of path, I wanted to bring in seasoned players. And so we put together a killer team. My co-founder, my partner, COO, Rob Slater. Rob was a program manager at Air Force Research Laboratory. He was a major in the Air Force. I wanted to bring on an operating partner from an internal ops standpoint that knew how to deliver on extremely complicated technology. We brought on Steve Thomas as our chief growth officer. Steve, actually, I intentionally wanted a chief growth officer that was formerly a CEO of a software company. And so Steve, he founded a company called Pathlore, which was actually probably the first learning management system in existence. And he exited a publicly traded company, and I convinced him to come out of retirement and work with 10XTS to run sales. We also brought on, economics guys, brought on banking. I've got a chief math officer who's a Max Planck Institute postdoc senior research fellow. So what we did was we set out to essentially define and build our own blockchain. We saw the holes in the market when it came to the traditional public space. In particular, I rail a lot on the risks and security associated with building on top of public cryptocurrencies like Ethereum. In particular, we're not Ethereum, not a fan, which also makes me unpopular in the crypto space. And there's reasons for that. The crypto space is full of a lot of young guys that have never worked at any senior level in enterprise IT. They don't understand things like Sarbanes-Oxley and the efficacy of your data when it comes to compliance with regard to your corporate information, and how is a public cryptocurrency blockchain going to play into that from an ISO standard standpoint to, how is it governed? And we saw the problems, and you see the issues with even the consensus between the miners in the public cryptocurrency space, resulting in radical forks of the ledger, as the miners, the people responsible for maintaining and governing the ledger, they don't agree with each other. And now, as a higher order application user, I'm designing an application, or I'm trying to bake that into my IT stack somehow. Now I've got decisions to make that are based on decisions being made by people other than me. So I don't really have a strong representative voice in how my data utility infrastructure is being maintained and managed. And if it forks in such a way that, the new fork requires me to now spend additional new money to integrate and update, rip and replace, these are all the kinds of things that the traditional crypto space don't understand when they're dreaming of, mass adoption and Main Street enterprise use cases. Just this nuance of having a ledger that is owned by the enterprise community, that's managed by key enterprise communities, with all of the risk and compliance and governance and reporting, all of those things maintained from day one. We saw that as really being a rubber meet the road opportunity for us, which is why we started working on building out XDEX. And our next step is to start to decentralize the actual core ledger itself from a consensus and node standpoint across a community of self-interested actors that would participate in the chain. So we're essentially selling nodes at the enterprise level as a turnkey application product stack that we can turn on. But the other difference that we saw the ledger as certainly separate technology from the rest of the stack, but at the same time, who wants to develop microservices, right? I mean, so we saw the opportunity to essentially the ledger and the protocol in a microservices layer to make it easier to develop against and integrate. So building that out as a turnkey type of a development stack for the ecosystem, we believe is another major differentiating factor for us, because now I'm just consuming as a developer endpoints and webhooks, as opposed to actually having to write these things and create protocol communication translation layer back and forth with the ledger. So that's kind of where we're at.
If I were to boil that down, just so I understand this, you guys were looking at an impending need for the enterprise community to have a blockchain style ledger. And you looked at the crypto environment or the blockchain environment, decided what was out there wasn't going to work the way those customers would need. And so that is why you began 10XDS and now XDEX to create that.
Yes, you got it.
And how do your services like XTS Core, XTS Connect, and XTS Launch, were those temporary services or those consulting type services that you guys offer on the route to XDEX, or are those something separate?
Yeah, you nailed it. I mean, it's basically when we started developing, we broke apart and identified all of the key pieces of the puzzle, what it takes to create a blockchain application or integrate a ledger into an existing application. What are all of those components? So that was our first iteration of productizing the service, essentially.
Mm-hmm.
So it makes it easy to talk about things in a pieces and parts Lego type model with lesser knowledgeable folks about blockchain, if you can relate them to things they already know and understand, and really trying to create a manifest of internal development modules, basically. So the idea of componentization for us in our pursuit to essentially build, call it the Salesforce of enterprise blockchain for specific verticals, that's really represented in that breakdown. And it's led us into a lot of awesome conversations. No enterprise development conversation is short. The sales cycles are very long, especially at this stage. Very laden with education and, just a lot of time because of where we're still at in terms of the evolution and development of the market itself. How do you get out there and start talking about things while still building towards the real foundation product, so to speak, which is a combination of those, separate pieces and parts, basically.
What does the governance structure look like on XDEX? Because I can imagine as you're doing sales, that's got to be a point of contention between, I'm not sure who your potential customers are, but let's say a regional bank and a national bank, they're going to have different views of how governance should be handled. What have you heard?
So, I mean, obviously the banks have been exploring, the big banks in particular have been working on their own consortium with R3 and Corda as the ledger. At this point, I would be hesitant to even call Corda an actual blockchain, which is okay. It's fine. I mean, but from a purist standpoint, they've modified that core framework so much. But as long as it meets their use case from a consortium standpoint, I mean, awesome. They're solving their problems. And the big banks can afford to do those things. We're looking at the market as any other market that you've got the big players, the major, say top third of the market that's just going to go do their own thing. Then you've really got, say there's a mid band that may swing either direction, but then you've got maybe the lower third of the market that represents the SMBs and the mid markets that will not have the expertise and the skill sets and the budget to engage in that high level of a proof of concept and R&D effort as an industry consortium. They'll still want to capture those opportunities and the return on the investment that's promised by the technology. And my focus is really going to ultimately be on that SMB and mid-market space. But to answer your question about governance, when we were in our R&D mode and we were evaluating different consensus protocols, we realized that proof of stake was, number one, a better technology approach from a just performance of the network and throughput of transactions on the network. And we realized that, staking provides the voting mechanism to adequately handle in a democratic fashion the support of the chain. The idea of a particular constituent wanting to influence the direction of the ledger and the blockchain infrastructure itself is a function of investing in the chain, right? If you want things to happen in the chain, buy in deeper and vote your stake, and providing a path to be able to do that easily. Because, right now in particular proof of work environments, it's a complicated process to vote. It's basically I have to run a version of the software or, pick which version I'm going to support. And, so trying to get that consensus across the mining community is, haphazard and ad hoc at best. Whereas designing an intentional democratic governance model going in, lay out the framework of what it looks like from an executive committee that essentially votes on all of the parameters of the blockchain, but then you have primary nodes that are voted into place that are able to actually write to the chain as active witnesses. And then you have the non-writing witnesses that essentially aggregate transactions and provide validation to the ledger for the active witnesses themselves. So anytime a witness is non-performing, they can simply be they can be voted out. But providing that voting mechanism within the actual chain framework really solves a lot of that governance problem.
Can you explain a world to me where this is in place? Let's fast forward, and actually I'd love to hear what your thought on timelines is. But let's fast forward some number of years and say you are wildly successful. What does that world look like, and how does, whether it's XDEX or something else coming soon, manifest on a day-to-day level to your clients?
Well, there's a couple of layers of clients. That's a great question. So when you stratify the clients, you have end user clients, right? Just common, ordinary, everyday people going about their everyday lives and business. And they're, conducting transactions, and they're managing their financial portfolios through software platforms that are not necessarily going to be radically different than the ones that they're using today. It's numbers on a screen. So from the end user standpoint, there should be no awareness of the blockchain. There literally should be no awareness that this is a blockchain or a ledger that's managing all of this stuff underneath, because it's completely irrelevant, which I know is a shift right now because we crypto enthusiasts are like, I'm going to log into my wallet and look at my tokens, right? Mm-hmm. But in the end, it's like, well, I've already got an investor account at TD Ameritrade, and I can log in and I can look at my portfolio, and whether that's blockchain that's deriving those numbers and presenting them on the chain, or whether that's, a MongoDB and it's being pulled out of some centralized stack. None of that technology is apparent to the end user. So the second layer of user is, of course, the business user. And the business users care about their technology from a cost and efficiency standpoint. That's very important because as we end up moving forward into the ledger space, the promise of the efficiency models and elimination of tiers of intermediaries and middlemen, and all of the cost of actually maintaining the data itself and the connectivity to the ledger. Because if you look at it right now, everything from an enterprise standpoint you can do with a MongoDB and a VPN, right? But it's when I have a consortium of several hundred cooperative partners inside of a platform ecosystem, if I have to maintain as an IT manager, 700 discrete VPN connections and data connections and filter controls against my data stack to provide that common access layer across, multiply that times 700, right? So, you're doing, that's an awful lot of just IT work that has to be done to maintain the same level of transparency and access to the data across that entire consortium ecosystem. So when you look at like healthcare networks, for example, you've got hospital groups that work with hundreds of clinicians and clinics, right? All sharing, PHI, and having to maintain those dedicated hard-coded pipes of data across all of those organizations becomes incredibly redundant. So blockchain and distributed ledger becomes a better mortar between the bricks, essentially. Mm-hmm. So those guys care, right? They ultimately do care about the cost and the efficiency model of how they're managing their data. So, I don't know if did I answer the question right? I mean, I know that wasn't futurist.
Well, and so I guess the way you answer the question is, if you are successful, it manifests in just a smooth experience of the transactions of information and currency, I would suppose, without me really realizing it.
When we are successful at what we're doing, ultimately, we're less concerned about our brand visibility and awareness and people using our software versus working with our consortium partners and enterprise partners almost from a white label basis. When I said, we want to kind of be the Salesforce of enterprise blockchain, it's exactly that. They already have, if it's a, financial services firm, they've already got investor portals and investor accounts. Why do I need to cash burn for customer acquisition at the end user level to try to onboard individual discrete customers at the cost of hundreds of dollars each, right? To make the cut on a network economics model for sustainability of the framework, when I've got, say, one small broker dealer may have 20, 30,000 investor accounts, right? So my approach is, how do I work within the confines of their existing front-end retail storefront portal and connect our framework to present through their portal to their end users?
So let's say you're approaching me, you guys are going into a new capital raise, and you're talking about this opportunity. How do you quantify this opportunity, how big it is?
Oh, wow, that's a big one. That's a great question in terms of what the industry evolution looks like for us. I can go and derive some Gartner numbers who've indicated 176 billion by 2025. 85% of banking CIOs have indicated interest in blockchain technology. Financial services is by far the most evolved and leads the pack of the rest of the industries that we're tracking. And so right now, I threw out the 1% number of CIOs that we're actively working. It's actually 5% in financial services. So you've got a 5x multiple of CIOs in the space that are actually already working, and about just shy of half have plans in the short to medium term. The U.S. is expected to see the greatest adoption globally within the next 2 years. We're getting ready to experience a huge surge. This past couple of years, we kind of got clouded a little bit because of the, crypto billionaire conversation and ICOs, and which I believe was actually it's a double-edged sword, right? It helped advance the awareness of the technology, but at the same time, it hurt the technology because of the scams and the nonsense that has gone on in the crypto space. And that translates into risk. Every time there's a risk that gets thrown up on the map for enterprise, it translates into, let's stomp on the clutch here and go to neutral for a minute and watch and see where this thing goes. In fact, about Ernst & Young ran a poll earlier this year. About 61% of IT CIOs and industry professionals saw regulatory complexity as the biggest barrier to widespread adoption. And then the second was integration with legacy technology at 51%. And just slightly below that, a lack of general understanding of blockchain's capabilities as a whole at like 49%. So those are your top three significant barriers in the industry space from enterprise perspective around the adoption and evolution of blockchain. But we're on the cusp of this hockey stick, right? So I think those are going to get sorted out.
I would love to hear when you say on the cusp, let's say that financial institutions are the leading enterprise adopter of this technology. What's the time frame on that? When do they employ this in a meaningful way?
It's going to be a mad dash scramble, probably kick in late this year. And I think it's going to be a mad dash scramble through to 2022. Next 3 years.
How does XDEX capitalize on that? How does XDEX make money? What's the business model there?
So we have a combined revenue model for us. Obviously, transaction fees inside of the chain itself helps to grow the economic value through network effect. The more users of the chain, we have a fixed internal token model that is the transaction settlement token inside. We've been very careful to map that out, follow not only the SEC regulations around securities, which we're very intimately aware of, but also FinCEN, right? Early in the industry, there was a lot of discussion on Bitcoin talk and among the mining community in 2013, 2014 around is Bitcoin even legal, right? Mm-hmm. And FinCEN put out a series of pronouncements and bulletins. They analyzed Ripple, for example. There was a fairly significant dialogue that went on around convertible virtual currencies, money services, business licensing. What does all of that look like? And FinCEN kind of put out some not very easily defined parameters, but they were very clear in their definitions of what constitutes a convertible virtual currency. How do you generate that? How do you acquire that? And so we followed all of those when designing our ecosystem. So we do have an internal currency token that pays for services on the platform. And then there's higher order applications as well, which is basically metered APIs. So you've got the blockchain from a transaction ledger standpoint. You've got API access for higher order functions. And there's an entire product roadmap around that. And hopefully we won't be the only ones designing those applications as well. As the ecosystem widens, there'll be other higher order cloud services application developers that will also start to plug in and realize what we're doing. But then there's also the Red Hat model, right? So, I'm not necessarily a big fan of Red Hat when it comes to an economic model, because I think that they run behind in terms of having the capital to conduct a lot of R&D to keep them relevant in the space when you look at like Microsoft and Google and Amazon. But at the same time, there's a significant level of services and consulting that goes along with that. And then 10XTS also has sort of a venture lab component that's attached to it as well, because we've been approached by so many other companies that are interested in launching projects and being involved in the space and leveraging our expertise as advisors and technology developers to develop products in conjunction with partners. We actually have 6-7 different revenues areas that we're looking at in terms of potential revenue stream.
So you mentioned earlier one of the revenue models is the 10XTS internal token. That will be only available to the enterprises that join the network, or how is that going to be issued? What are the token economics look like on that?
Yeah, so it's XDEX token. That is ultimately a stored value token. I mean, it's a commodity token. One of the things that we've done, and we're getting ready to push the window on this in terms of how we go to market, our next round, we're actually getting ready to go through a regulation crowdfunding campaign. We're going to raise $1 million in a CF campaign for ultimately non-accredited investors, which means the average person can legally buy into this opportunity. And the way we're doing it is we're actually selling equity in 10XTS. You're buying traditional shares in the company. Our innovation, and this is one of the problems with the space, and I talk to regulators and talk to attorneys, and I talk to I've been working with Congressman Warren Davidson's office. Warren sits on the House Committee for Financial Services, and he's been tapped by the chair of the committee to draft the whatever it's going to be, the ICO and blockchain legislation for the House. And so we've been, really trying to peel the onion here on a bunch of things. But the point that I made early on to these guys, and talking to, like the United States Chamber of Commerce, they've got a CTEC group, which is their emerging technologies, and their capital markets group, working with the U.S. Chamber in D.C., and then working with the House, we don't have a taxonomy. There are no law words in the U.S. Code that say things like ledger or blockchain or decentralization. All of these are being tossed around by the industry and by even the SEC, for example, but there's no codification in U.S. law to even derive the meaning for the taxonomy. And we don't have a common taxonomy. So how are we going to legislate things that don't have a common language that we all speak and understand across the board? Now, why this is important is we saw this as an opportunity to sort of split hairs here. So you have the internal convertible virtual currency stored value token that's a commodity that's being generated through the blockchain, writing blocks to the ledger, and just like mining for Bitcoin, for example. You find transactions, you write them to the ledger, and you get a Bitcoin. And I've written extensively about how this is very analogous to the early days of even mainframe computing, where you rented processor time. And you paid for it as a service, and you marched down your paper tape or your punch cards or your mag tape, and you mounted it on the You mounted it on the drive and you ran your program and you got your green bar output report and you got a bill that represented processor cycles. How much time in processing did you actually consume on the platform? So that's a parallel to ultimately when you're writing transactions to a blockchain ledger, the miners or the witnesses that are writing through their hashing power, their computing power, they are performing a service to maintain that entire blockchain. So the token that they are rewarded with represents payment for those services. No one is arguing that. The CFTC, the SEC, the Treasury Department, everyone's pretty much in line with that, which is why everybody says, well, sure, Bitcoin's legal, right? And from a proof of work standpoint, Ethereum's legal. The problem was with the way that Ethereum was funded, right? So is Ethereum actually a security even though it's being mined? Was it a security based on how they actually pre-sold the token in the crowd sale? Because you can make a brick a security. You know, if I say, hey, Jay, Eric, buy this jelly donut from me for $100 and you'll be able to resell it next week for $10,000. Well, in that instance, I just, through my language and how I promoted that to you, turned a jelly donut into a security, which isn't registered. You know, you're never going to buy the XDEX token in a Reg A, for example, because there's no assurance that if I sell it in a securities offering, that it will ever lose the security status, even though Bill Heinemann and Jay Clayton, those guys say, well, there could be a token that starts as a security, but then eventually is not one anymore. Well, show me in federal code what those threshold metrics are. Who's making the decision? Because it still sounds really subjective. And I'm not going to put my company and my investors and my stakeholders, my users at risk by rushing in. And then we've created a separate token that represents a nano services license. So when you look at software and computing services in terms of licensing and services models, we already pay for API, metered API connections now. The missing ingredient with a lot of the ICO space is they declare themselves to be a utility token, but then they don't back that up with legal evidence from a contractual standpoint that spells out the terms of the license and what you're getting for this token. So we created a nano services token that cannot be exchanged or traded at all. It can only be purchased. And the only thing you can do with that token is convert it into our internal currency token in the future at your discretion. And that satisfies the Howey test, we believe. We'll find out. But we believe it satisfies the Howey test because the actual token being sold can never be exchanged or traded or transferred other than converting it into the internal currency token. Therefore, it was not purchased in any way, shape, or form with the presumption of profit. By just simply eliminating the presumption of profit through the efforts of third-party management, that sort of neuters the Howey claim.
What is the Howey test?
The Howey test is a famous case in, I think it was 1946. So it was the United States versus the W.J. Howey Company, where a landowner wanted to get into the citrus orange growing business and sold essentially a participation to people to buy into his operation. And he would manage and maintain the orange grove, and then you'd get shares of profits. And the SEC said, well, whoa, Nelly, this is a security. Therefore, we're taking you to court. And that was the case that really defined at the federal level what constitutes a security in the United States of America, and specifically why it is a security. This is still today the measuring stick that's being used by the SEC to determine whether an ICO or whether anything's a security.
Something from 1946.
Yeah, and the funny thing is when you abstract it away from a behavior and intent standpoint and don't even talk about technology, it's still pretty good. I mean, the United States has the most stable equity market in the world for a reason. You know, it's expensive to launch securities because of all the checks and balances and the assurances that it's not a scam, right? I mean, that's ultimately what the government is there to do, is to protect the investor and ensure that there's proper registration or exemption from registration under one of the clauses in the code, and proper reporting and accountability for information decision-making purposes. I don't challenge that. I think people are stupid to challenge that.
Mike, one of my last questions here. Why are you doing this in Cincinnati, Ohio? Is Cincinnati the best place for this? Is there some natural geographic advantage, or is it by happenstance?
It's happenstance. I mean, Cincy's a cheap place to live. I mean, let's cut to the chase. Yeah, I can live in a 3-2 on a half acre for under $500,000 in a really awesome part of town, 5,000 square foot house, and it's just an inexpensive place to live. It happens to be where we're all from, but even we've contemplated what's our B plans, right? If the SEC comes along and says, no, you guys' approach is wrong, all right, well, then we're offshore. Bottom line, I've already made that statement to the United States Chamber. I've made that statement to Congressman Warren Davidson directly to his face. And, it was interesting because his response to me was, well, if we can't get this stuff figured out, you're probably better off going to Switzerland or the Caymans. There's no reason to hold up your development. And that's a sitting congressman. I love the guy to death. He's as patriotic as it gets. He's a businessman at his core. And, when he's very knowledgeable about this space and he's looking at the playing field and he's, saying to us, and we're in district. So, once again, I got the golden ticket, drew the lucky card on that. I'm actually his constituent and we're in his district. Talk about lucky, right? So being able to sit down and have these conversations is already taking place. And it's just unfortunate that we're not moving fast enough in an orderly and an intelligent fashion to not stymie the development, which is why a group of us has sort of suggested, well, maybe we take a light touch with, some minimal registration so that they can keep tabs on the project. But then let's follow like the 1998 internet sales tax and put a moratorium in place for at least a few years. So we can still keep track of projects and you're going to have some tether to everybody involved in a project. So, if there's a fraudulent activity or something that takes place, we know where to go find you. But then, let's light touch, hands off, let's sandbox this out for a couple of years before we rush in with well-meaning intentions to define the law. And, that can be just as disastrous as going in with a wrecking ball. And, laws are not easy to change once they're on the books. So if it's a new law, that's one thing. If it's changing an existing law, we don't want to build barriers for ourselves down the road.
Regardless of where you guys end up, whether it's staying in Cincinnati or offshore, whatever the regulatory hurdles are, how do you guys define success? What are some of the KPIs that you're looking at in the next 6 to 18 months to say, okay, we are progressing well with XDEX?
Well, I mean, as a startup, if I'm still making payroll in 18 months, then that's a success of its own, right? So, let's get real practical about this. We're making payroll now, and we keep our cash burn light, which is the other benefit of Cincinnati, is because the price elasticity of the talent is certainly there. I would say that my next major benchmark for success is having a functioning ecosystem of financial services and financial players that have recognized what we're doing, bought in, and are participating in the consortium effort.
Like how many?
Well, I don't want any one financial player to operate more than 3 nodes. So this gets into our distribution and our governance model. Obviously, the executive committee can define how many nodes are necessary. We can run 100,000 transactions a second on 21 discrete nodes, writing to the blockchain, which is very important from a technology and a transactional throughput standpoint, because you don't want any of the latency that's associated with current cryptocurrency models. When your CryptoKitties application is delaying your security settlement, that's a problem. So right now we're targeting 21 nodes total. We'll still operate probably 3 of them into the future. So you've got some n number mix of financial players that would represent 1 node each or up to 3 nodes each. And that's my goal through 2019, is to really decentralize the active primary witness operators that are supporting the ledger while also supporting and maintaining external application development projects from, a higher order cloud layer through ecosystem application partners, basically. Whether that's a startup that's leveraging our chain to launch their application, whether that's a broker dealer wanting to start the integration process to their existing investor portal so that they can enable blockchain-based security trading in the future, those kinds of things. Yeah, it's a target-rich environment right now. Everybody's got a lot of ideas. I'm sort of Jerry Maguire about it, show me the money. Because in startup land, there's a metric that no one really talks about much called cost of attention. And, I only have so many hours in the day, and my team only has so many hours in a day collectively to carry on conversations and discussions. And I'm really big on kill it fast, because it's already a very time-laden discussion, and we got to zero in on the ones that we think are going to be success versus the tire kicker kangaroos that are out there. Hey, I pick your brain. Can I get coffee? Yeah, $600 an hour. I'll even buy the coffee. So,
all right. One last question on numbers from me, and then I think we can. If Jay have anything else, how many people are full time on your team right now?
1, 2, 3, 4, 5, 6, 7, 8.
8, and are they mostly developers at this point, and
yeah.
Plus a sales guy? Okay.
Yeah, we're heavily weighted. Myself, our chief operations, CTO, and lead dev, and we've got some other developers with our chief growth officer. We're contemplating bringing on a full-time services director to manage the enterprise side, because one of the things that happens is, you've got this conflict between making payroll and cash runway, and there's tons of awesome enterprise services out there that can be pursued, but I don't want to derail the product team away from their focus. So making that separation and, really starting to pull the trigger on some services type stuff without distracting the development of the product itself and keeping the product roadmap in check. That's a big thing for me. Plus, my product guys hate enterprise. I want to destroy and crush their souls, put them in a Capgemini cubicle. That they're in startup product for a reason.
Last question from me. Do the names 10XTS or XDEX derive from something? Are those abbreviations?
Yeah, 10XTS literally stands for 10X this. So no qualms about it. That was the whole baking in some tongue in cheek. So 10XTS Inc. does actually stand for 10X this. And, I can come up with some other acronym for polite conversation. Oh, yeah, it's binary external transaction system, whatever, come up with something. But XDEX was just basically keeping the X theme with 10XTS along with the decentralized exchange, because we have inside of the protocol a completely decentralized trading engine that will only be turned on in regulatory compliant fashion, based on whether it's through a licensed broker dealer that's got a ATS license portal. So it's not like a take all comers, hey, come trade your crypto kind of a thing, but the power is there, and ultimately it will evolve into the future into a full blown decentralized exchange trading platform for all of these tokenized assets.
After our show, where can listeners learn more about you or 10XTS?
So I'm pretty prolific, easy to find on social. I'm at Michael Hiles on Twitter. Hit me up on LinkedIn. I got a lot of followers on LinkedIn. And then, of course, 10XTS10xts.com. Keep track of all the latest and greatest musings and news articles. And, we'll be far more prolific here going into the fall with the Reg CF. And promoting, obviously, that opportunity through regulatory compliant fashion. So those announcements will only be made directly through, the regulatory compliant channels for marketing for a securities offering. But, just jump on the mailing list. We don't bombard people with a bunch of inbox stuff right now, but that'll pick up in the future. If you sign up, you obviously wanted to hear from us anyway. So I encourage people to talk to us. We're pretty easy to find.
All right. Michael, thanks for being on the show.
Thanks, guys. Appreciate it.
All right, Eric. So we just spoke with Michael Hiles, the founder and CEO of 10XTS. Can you share with the listeners what we're about to do in this third segment, my favorite segment of our show?
I think it's also my favorite segment of the show. But we are going to do our verbal hypothetical deal memo. Imagine that Jay and I are running a angel fund or venture capital fund, and we want to look at and evaluate deals. Well, the deal memo is a way for us to think about what's the upside, what's the downside, what are some of the risks associated with the company, and communicate that both to ourselves and our investors. It gives us a basis to look back in 6 to 18 months and say, okay, we had this right, we had this wrong, and kind of weigh our own thoughts. One thing that I think is prescient here is something that Pomp said in our intro. He said that people can't lose their minds when it comes to crypto, and I think that's very true in the venture capital space. We need to evaluate this deal, this opportunity, in the same way, with some nuances, that we would any deal that comes through the door. Do you agree, Jay?
Yeah, I agree. I like that. And specifically, we're looking to answer 4 questions here in this section, whether explicitly or implicitly through our discussion. And those 4 questions are: 1, how committed is this founder? 2, what are the founder's chances of success in business and in life? This business, I should say. 3, what does winning look like in terms of revenue and my return as an investor? And 4, why has this founder chosen this business? So pretty founder-centric here. And Eric, I think that might be a good place for us to start, as we often do, with Michael Hiles.
Yeah, let's start with Michael, and then I'd like to jump into, to look at this a little bit differently, into the framework. So let's just kind of futurecast that. But Michael has a really, what he called the Willy Wonka story. This golden ticket. He was born into a family that was technical by nature. He had access to a lot of equipment. He had access to coding. He got lucky, it sounded like. It was a mix of luck and opportunity at the radio station. And just a lot of great things that have played out to let him be the overlap between a sales guy and a technical founder, which is very rare.
And I think besides just whether objectively or not he was lucky, I think a founder with the mindset of gratitude and a feeling of luck is a good sign, because generally, in my experience, folks who are grateful for what they have and what they've accomplished are generally a little bit more resilient and a little bit more prone to success. So I think that looks good for Michael. He's also been heavily involved in the computer science engineering space for a long time. He was throwing out a lot of acronyms from the early days of computing and the internet that I just had not heard of. So cannot confirm or deny whether those are legitimate or not, because it just predates my time. But point being, he's been in the space and at the fringes of technology for a very long time. The point he made about token ring not being a necessarily new technology and peer-to-peer being around for a while, I think was prescient as it comes to blockchain in this interview.
Look at us, both using the word prescient in the same deal memo.
Yeah, you incepted it. You primed me.
I think it's fascinating because you do hear in the news how revolutionary and game-changing, and this is such a great leap forward for the technology space. But Michael kind of put a damper on that, and he said, look, this is the natural evolution. It's a great evolution, but it's a natural evolution, and we're excited about it. And there's still some runway here. And he saw a lot of comparisons to what he was doing in the 90s, working on the web and the internet. So looking at that lens, I'd like to kind of take the listeners back through what we talked about, through the feeling of a cryptocurrency and the different types that are out there, because this is a very, especially if you're not familiar with it, confusing space, because it is so hypothetical, it is so new. And we laid out a framework with Pomp early on in the episode, which said that there are effectively 3 buckets of cryptocurrencies or tokens. Those are payment coins, which is the Bitcoins of the world, platform and utility tokens, which are, in my opinion, a platform token here would be something represented underneath 10xTS, and utility tokens, which are, Michael mentioned, a startup launching their application on the 10xTS blockchain. That would be something that fits there. And then the final bucket is tokenized security, which we spent a lot of time on the intro talking about. And I believe that the financial institutions that are going to be clients for 10xTS will be heavily focused in the tokenized security space.
Eric, is it your understanding that this tokenized security space is what Michael was ballparking at the $175 billion range by 2025?
To be honest, I'm not really sure how that number fits in. I understand that it is a very large number, and sometimes when numbers get so large, it gets a little confusing as to where they come from. I do know that this market in general is massive. So when I think about the number of assets that could come onto a platform like 10xTS, I think that 176 billion, to be honest, probably seems a little shallow. So that's maybe not the exact answer you were looking for, but I think that it is a very large number, and the space is very large when you're looking specifically at financial institutions that Michael mentioned are in the probably not going to invest in developing their own blockchain space. What was your take on Michael's kind of dual structure of customers? He has the businesses on one side and the users on the other.
We spent a lot of time talking about the businesses, which is where I focused most of my personal attention on the opportunity, because it seemed to me that his stance for a lot of the interview was, I'm not trying to take a front end branding on my DApp perspective and focus, like he said, DApp being a acronym for decentralized app. I'm going to focus on serving these customers from a white label perspective. He used the metaphor Salesforce for enterprise blockchain. And so to me, that speaks to his focus on the SMBs to mid-size companies being his biggest customers. So he mentioned there are three segments: the top third, which are these larger institutional clients that are going to go and do their own thing; a middle third who can kind of go either way; and the bottom third that is this SMBs that he would lean to more as their customers. I don't know if $176 billion was the total market size and that divides into thirds with those groups, or if he's saying $176 billion was that bottom third. But to me, the opportunity is whether or not he can service that bottom third and some of that middle third with his Salesforce for enterprise blockchain white labeled solution. Something he kept talking about was how it would be difficult for that segment of the customer base to create their own consortiums. And I believe that is sort of this public versus private blockchain analogy, which you've talked to me about a little bit. Can you share some of that for the listeners and what you understand to be a consortium?
So looking at public blockchains, those are blockchains that are available to anyone in the world. You can download the ledger. You can see how transactions are going through. If I wanted to right now, I could go download the entire Bitcoin blockchain and see how wallets trace from transaction to transactions through the history of the blockchain. It's one of the immutable properties of blockchain or distributed ledger technology. On the private side of things, you have a blockchain which is governed by either one or a few different entities. A consortium is a private blockchain where there are I guess it could be a public blockchain as well, but it's a group of banks or group of just enterprises that are going to be the governing body and have majority votership effectively of the blockchain. What that means is that there's more control in a consortium-based environment. What Michael's proposing is that these small to medium-sized businesses and financial institutions aren't going to put up the capital to develop their own blockchain, which is extremely expensive, especially at this point, to join or work with a bunch of other SMBs to develop some sort of consortium blockchain that works for everyone. It's almost impractical and infeasible at this point. But if he brings a product to them that says, here's all the benefits that Chase is getting by their consortium with I think they're at R3, which is out of London, then that is a huge potential benefit in terms of cost and in terms of being able to utilize this technology that all the big players are using and being able to utilize that.
This is so hard to talk about in concrete terms. It seems so abstract, and I feel like a noob, as people would call it. So the benefits of a consortium, or a consortium, depending on your pronunciation, what are those benefits?
It's mostly control. It's mostly control over the blockchain, guaranteeing the transactions, and being able to have the voting
power that comes with being one of the consortium members, which means that, and this is the way I understand it, I'm not the most technical person in the world, but it means that you're probably operating one of the nodes, which are the verifiers of transactions on the network. Michael said they're going to have 21 nodes. They're going to sell node space to up to 18 different financial institutions. You could see that going further in the future as more nodes are allowed on the blockchain. But this entire opportunity is, like you say, very abstract. It is hard to quantify because it is based on, I think, very solid assumptions. But the future of this technology and the future of how it is utilized and the regulations, everything is so in flux. It's a huge problem with a lot of huge issues and not a lot of people who are doing anything in it from a financial institution space yet. Michael mentioned 1% of CIOs.
That was interesting to me, and that it's a 5x multiplier for financial institutions. They're at 5% of CIOs are looking at doing something. Something that both Michael stated and Pomp said, he more alluded to in our interview, but I've heard Pomp say in other interviews. It's this idea that the pendulum seems to be swinging, that players in the blockchain space are thinking more seriously about how do we play with existing regulation and existing law so that we can issue things legally. It seems like the ICO trend could be in potentially big trouble, and people are saying, whoops, better stay away from that. And Michael alluded to both cryptocurrency and ICOs as kind of running ahead of things and not understanding, as he put it, some enterprise and things like Sarbanes-Oxley, and that he sees the opportunity in working with regulators to do that. He name dropped a congressman that he's working with in Cincinnati to write some of that law because there aren't taxonomies, as he said it, in U.S. existing law to even say things like ledger and blockchain and decentralized, so it's hard to regulate. It seems like it's a risk from our country's standpoint of getting some of these things written so we can lead or even, allow the innovation in this space to exist. So to me, exciting things from 10xDS's perspective. And when I say 10xDS, I'm speaking mostly about XDEX and this product, XDEX. 10xDS as a shop that develops technologies could be a profitable venture, I'm sure, but services businesses aren't generally what you would invest in from an institutional level. So the exciting thing about this to me is that this is a different approach than we hear very often. The pro-regulation, work with the powers that be approach, it seems to de-risk a little bit what is a difficult to understand and risky space.
I agree. I think that if we think about this as a traditional business, let's think about this as a software business that's going to sell a platform to a bunch of financial institutions. Some of the similar characteristics that go through that are really long sales cycles, because imagine getting Fifth Third Bank to agree to putting anything on a piece of software. It's got to take months, if not years. The same thing goes for Huntington and all these other banks that are regional and small.
And that's sales, and then there's implementation.
Oh, of course. I mean, when you look at some of the big implementation consulting shops, it takes them years to develop softwares. So this is a long view process. This is not, this thing is going to pop in a couple of months. I think it's interesting that they're doing a crowdfunding raise coming up here instead of pursuing a larger Series A raise.
For ownership in 10xDS. So I'm curious to see what does that mean for if I'm trying to support XDEX. I guess 10xDS is the whole owner of XDEX, so one would assume that this kind of concern I'm voicing isn't really a concern. They're not two separate businesses.
I think it's more so it's equity rather than tokens. They could sell their internal tokens as a Reg CF offering, but they're not doing that. They are selling equity in 10xTS, which I guess at this point, people are taking such a long view and almost a risk in investing and giving $1.07 million to 10xTS, assuming that they raise the full amount, that I guess that makes sense. They want more people in 10xTS as an equity vehicle, and maybe they're not comfortable enough with the regulation yet to say we're going to do a SAFT or a sale agreement for future tokens. Looking at other things that we can kind of pull out of this business, we have a long sales cycle. We have a huge market opportunity. We have an interesting equity raise. We have multiple raises to date that I can find. We have what seems like a great leadership team and an experienced leadership team that you're going to need to go in and pitch to these financial institutions. There's a lot of the pieces that if we were looking at a traditional business would be great, in place, check the box, move on, and let's ask some of the harder questions.
I'm also going to make the assumption that the customers they seek to serve would become pretty loyal, sticky customers the same way any enterprise software going into a company at that type of level would be.
Yeah. When I worked at OSU, we used PeopleSoft by Oracle, and it felt like it was implemented in the 1970s. So I think that once you get a big institutional customer, the switching costs are just massive.
Can you imagine the day when blockchain technology feels like it's decades old?
Yeah, it'll be the same day when I'm selling those damn kids. Okay, so I think that from a business standpoint, it checks a lot of boxes. What are the risks that you're worried about, Jay?
As new as this is and as unproven as it is, that in itself is a risk to me. Like, as an investor, we talk about this sometimes. If I'm not feeling comfortable with this and my knowledge of this, should I be learning as much as I can more and continue considering this as an investment? Or should I say, this is so far outside my wheelhouse, I'm going to not dedicate more mental capacity and time to understand it and instead just talk to 10 more entrepreneurs and pick one of them? That's something that we come across in the Lawn Guru interview. The West Coast investors who said, we don't have lawns, we don't get it, and passed. And we made the joke, well, couldn't they just call 3 people in the Midwest and talk to them about it? I am now in those shoes. Can I call somebody now and ask them? I mean, that's basically what we did with Pomp. And so Pomp looks at this and he said, are we looking at selling the shovels and the tools, the infrastructure, or are we looking at the coins? And XDEX is an infrastructure play. Am I correct in saying that? So
I would agree with that.
Would you liken XDEX to Securitize, Harbor, or Templum? I don't know those platforms very well.
I would not. I would liken it to a niche version of an Ethereum at a very basic level. I know Michael might hate that comparison, but the idea is that it's a platform on which you can build and utilize tokens, much like Ethereum is a platform. They both develop blockchains. They both are serving a specific need. Ethereum's is a little bit wide-ranging, and maybe some of the ways that it was gone about and some of the underlying technicals are different. But from a broad brush stroke, it's a platform that is serving a specific need that is allowed to be built on. We talked about those 3, let's go back to that framework, those 3 types of tokens. The platform token in the middle, Ethereum, is a platform, and EOS is built on top of it. 10xTS, XDEX is a platform. It's to be seen what's going to be built on top of it.
And the things that are built on top of it can issue their own tokenized securities.
Correct.
What I did like about this is, probably putting the red hat path aside, there are still multiple streams of revenue that could occur from the XDEX platform. And I'm trying to pull up my notes now. Obviously, the transactions that happen within it, which would be, in my assumption, the biggest opportunity. You have transactions flowing through it all the time.
To be honest, the revenue side of things doesn't really concern me, because the market size is so big that if you can capture the market size, the revenues will follow because of the stickiness of the customers. So once you have someone on your network and they're utilizing it, the pricing power is going to be there. Your revenues are it's why Binance can throw $10 million at 10 different governments, because they were one of the first different exchanges to set up and dominate. And it's such a new business that the margins are so large that the cash is just flowing in. And I think that it will be very similar to 10xTS if they can get the financial institutions on board, because once they're on the platform, there's really no easy way off.
Something that's interesting that Pomp mentioned is when looking at this as a traditional investor, he said you look at what is the upside, what is the downside. He said crypto investors typically look at things as how high can this get, and institutional investors look at things as how low can this get. From a venture capitalist point of view or an angel point of view, you're betting that a lot of your investments go to zero anyway, right? So you're often looking how high can this go, in my opinion. If you're looking at this opportunity, lowest it could go seems like zero, right? Isn't that kind of the lowest anything can go?
Yeah, but I don't think this goes to zero because they have a blockchain development shop. So worst comes to worst, XDEX fails miserably, and they just revert back to developing dApps for other people, developing any kind of blockchain. I mean, they have what I assume is 3 to 5 blockchain developers, and they estimate there's only 5,000 in the world. So you have a pretty high number of blockchain developers. I can tell you that is a lot for a small shop.
And so, yeah, what I'm kind of getting to here, the risks are going to zero or getting close to zero. Regulatory risk, which it seems like he's hedging against. So in a lot of ways, as an investment, taking crypto out of it and just looking at it and not losing my head in Pomp speak, it seems like they're de-risking a lot of things that come with the blockchain crypto space. So,
and I think that we're both Midwesterners, and we talk about how Midwesterners are sometimes scared to take these kind of bigger, scarier bets, especially Midwestern VCs. And when you kind of rip apart the crypto aspect of it and you just get down to the basic business, I think that the model makes a lot of sense. And it's not as scary and like fang-toothed as we were maybe making it out to be in the first half of the Steele memo.
Model seems clear. A couple of stats that Michael threw out, which I have not fact-checked, but let's take his word on it. 85% of banking CEOs have indicated interest in blockchain technology, but 61% saw regulatory complexity as the biggest area to implementing. 51% saw existing enterprise technology as a barrier. And those are two things that he's attacking head on for that segment of the market that can't afford and don't have the skill sets to develop it in-house.
So let's look at 6 to 18 months from now, Jay. What are you looking at from 10XTS? Is that too short of a time frame? What would you want to see?
Based on Michael's own timelines, I'm going to say it's not too short of a time frame because he estimated a, quote, mad dash at the end of 2018 through about 2022. So what I'm looking at is how is momentum with XDEX from a couple angles. Are they continuing to put blocks on the chain, which is something that he talked about lightly, but I've seen that's a press release they released, so it seems to be a focus of theirs. Is he still working with the congressman from Cincinnati, and is that making positive progress? Is the United States as a whole making positive regulatory progress so that it can be a fertile ground to do this? Does he have to move offshore? Is he still making payroll? This is a pretty legitimate team, and I have no data to support that they're not committed, but such a talented team, their skills are always in high demand. Their opportunity cost is always high. So 6 to 18 months from now, is that team still together? Is it even stronger? Is the regulatory environment, which is kind of what they're piggybacking off of, in a strong enough place for them to continue?
Yeah, so I definitely agree with all of those. I would be curious to see how customer discussions have progressed. Have they signed a lot of NDAs? Have they brought on some tentative commits, some verbal commits? Have they ran a couple pilots? What's going on in all of that space? My final thoughts and my closing thoughts are that we don't know whether or not there's going to be 1 or 2 major blockchains out there that just dominate everything and everyone uses them. And that's kind of the Ethereum model, which is the Ethereum virtual machine, and the Bitcoin model, which is we can use everything everywhere. Or if there's going to be hundreds of these blockchains, thousands of these blockchains, millions of these blockchains that each serve a very specific purpose. And I think that there will be, like, this is my personal view, there will be something like 10XTS, which is differentiated and serves a very specific purpose for a lot of different industries. And financial institutions will probably be the first one that happens. I'm interested to see if 10XTS
is going to come out on top there.
Cool. Well, thanks, guys. Thanks for listening. This is a complicated one. Thanks again to Pomp for being on the show and Michael. If you guys have any thoughts, we'd love to hear them. I certainly could use some educating myself. Please tweet at us at UpsideFM or email us hello@upside.fm. We'd love to hear from you and hear your thoughts on Twitter or on Breaker. Breaker is our preferred podcasting app. And of course, if you enjoyed this episode, please leave a rating or review on iTunes. Helps us a ton. It's been going well so far, but yeah, we'd love to keep seeing some of that love. So we will talk to you guys next week. That's all for this week. Thanks for listening. We'd love to hear your thoughts on today's guest, so shoot us an email at hello@upside.fm or find us on Twitter @UpsideFM. We'll be back here next week at the same time talking to another founder in our quest to find upside outside of Silicon Valley. If you or someone you know would make a good guest for our show, please email us or find us on Twitter and let us know. And if you love our show, please leave us a review on iTunes. That goes a long way in helping us spread the word and continue to help bring high-quality guests to the show. Eric and I decided there were a couple things we wanted to share with you at the end of the podcast, and so here we go. Eric Hornung and Jay Klaus are the founding parties of the Upside podcast. At the time of this recording, we do not own equity or other financial interest in the companies which appear on this show. All opinions expressed by podcast participants are solely their own opinion and do not reflect the opinions of Duff & Phelps LLC and its affiliates, Unreal Collective LLC and its affiliates, or any entity which employ us. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. We have not considered your specific financial situation nor provided any investment advice on this show. Thanks for listening, and we'll talk to you next week.
Never mind, bro, that can't be matched. I'm lighting it on fire, used to run victory laps, and still I'm not even tired. It's all about the timing, yeah, that's what they say. Well,